1, 2, 3, 4, 5, 6. Okay, it is 10 o'clock. We do not have a quorum, so there is no business we can conduct. But Jason, we can go ahead and hear the consultant's report.
I'm sorry, I was talking.
That's okay. Yeah, we need one more for a quorum, so we can't conduct any business, but we can go ahead and hear your report.
Okay.
Someone coming? Go ahead, please.
Go ahead. All right. Well, you have the October ASAP and the quarter report. I'll go through the quarter report primarily. Just certainly think it's important to make a few comments on the election, because certainly that's on everybody's mind. But I think in terms of a long-term investor like yourselves, nothing really should change in terms of your investment strategy or long-term strategic allocation. That said, from a manager perspective, there probably will be opportunities or changes in opportunity set going forward for managers, and that remains to be seen based on policy. I think the biggest things that still impact in the short term, emotions driving markets, although we haven't seen much of that the last 2 days so far. It's been fairly positive. The one thing that we have seen move pretty dramatically is yields on treasuries, up about 20 basis points yesterday. So the 10 years at about 210 this morning. Expectations for a December rate hike actually have gone up to 80% probability from 70. So that's not that big of a change. I think that was what markets are expecting. And for you all, what does that mean? Your fixed income, it's been positioned to have much less sensitivity to interest rate movements, and primarily to protect when interest rates start going up. And we've seen that benefit the last couple of months. Last year in 2015, that was a pretty big headwind as rates came down dramatically and really treasury prices went up. Bigger picture, fundamentally, things are still challenged. Valuations are high across the board in both equities and global bonds. There's not a lot of attractive places to put capital today. So maintaining diversification, maintaining a more flexible, opportunistic approach within mandates, and having some active management across the board within your portfolio, which has been a challenge, certainly. If we look back from 2008 till today, it's been pretty tough to beat the S&P 500 index as the U.S. large cap stocks have gone straight up. But going forward, with valuations fairly stretched, volatility probably becoming more pronounced, we think having that active management should be more beneficial.
Jason, just one quick question. Do we anticipate that the international markets are likely to be more volatile with the uncertainty?
I don't know that we necessarily anticipate U.S. versus non-U.S. being more volatile. I think there'll continue to be some currency volatility. The expectations now are that the Trump presidency should be pro-growth, which could be inflationary and put a headwind on the dollar, bringing the dollar down. And what that does for U.S. investors in other currencies as the dollar weakens, that could be a positive for you from the currency impact coming back the other way. Just from fundamental standpoint, non-U.S. stocks are not as stretched in terms of valuations as U.S. stocks now, because they've been down and beaten up so much over the last couple of years. So from that point of view, from a relative valuation standpoint, they appear to be a little bit more attractive today. So if you would, I'll just turn you to tab 2 in the quarter book. Won't spend too much time on the capital markets. We talked about that last month. So if you look at tab 2, page 22, This page 22 is a dollar reconciliation. At the end of the period, or the end of September, the portfolio stood at $662 million. That second column there is the 1-year change in value. So net additions of just under $20 million. So that's cash flows, benefits going out, benefits and expenses going out, plus any contributions coming in. The return on investment, which is the growth in the portfolio, just under $55 million. So ending that period at $662 million. Page 23 is a snapshot look at portfolio versus some bigger picture objectives, and focus on the first group there. That's we show 5 and 10 years. This has been a very good 5-year period. I think I probably mentioned it last month. I know your fiscal year is the calendar year, but there's a big difference between folks that have a June fiscal year and folks that would have had a September fiscal year, just from a measurement standpoint. At the 1-year period ending June, returns were effectively flat, and we had a very good quarter, and you took off a bad quarter from last year. That said, October's changed the view again, but just looking at this 5-year versus objectives, total portfolio, which is that middle column there, has a return of little over 10% annualized the trailing 5 years versus your primary objective, which is that 7.5% return. So a very good 5-year period, well above your objective. Relative to a policy index, which is how your assets are actually allocated, outperforming that by about 30 basis points. So the markets have rewarded you, and the markets have been good over that period, well above your primary objective, but your portfolio has added value as well. And we've done that with less risk, which is something that we always talk about. Really, that's the one thing you can control is risk. You really don't control return in as much as, for the most part, your returns are dictated by the direction of the markets, but you are defining what kind of risk you're taking by your asset allocation and your implementation. And you can see these risk metrics. The first one we show is standard deviation or volatility. You're about 30 basis points below in terms of the 5-year standard deviation. The second is beta, which is sensitivity to the direction of the movement of the market. You're below in terms of beta. And then down capture, which is an indication when the markets are going down, how much of that are you capturing? And you're capturing about 90% of the downside. We know when markets are going up, you're not capturing all of that, but that's okay because over time, by protecting in those more challenging environments, your assets compound at a greater rate. Over a 10-year period, the markets haven't given us that kind of return that we're looking for. Relative to your policy, you're right in line. The return is right in line with the policy objective, a little bit below the primary 7.5% objective. And we know there's going to be times when the markets aren't giving you that. But the risk is in line with where we would expect. Page 24 and 25 look at some allocation targets. Portfolio slightly overweight to equities. Within that, small cap is the biggest overweight. We have been we took from small cap last month for your operating needs, took from Earnest Partners. That's the primary means of rebalancing and getting back to targets. When you need to raise money for operating needs, we take it from what's most overweight. Fixed income is essentially at targets. Within fixed income, the core plus, or more flexible, opportunistic mandate of Western Asset Management is the most overweight, and that's been a very big positive for you. We'll look at that in a moment. More recently, the absolute return, which was somewhat of a headwind until the last couple of months as rates have started to come up. As rates have gone up, that PAMCO strategy has really been a good buffer, and it's produced positive returns in a period where bond prices are down. And then real estate, slight underweight there. That's primarily in that opportunistic real estate, which is functions like private equity. We have to make commitments to that. Money is called down over time. That's still fairly in its infancy, so you're a little bit underweight there. That said, the real estate portfolio has produced good returns. Page 25 is just a look through at the emerging market exposure. It's a little bit higher now because emerging markets have done so well. So within some of the portfolios that aren't dedicated emerging, some of that EM exposure has crept up a bit. So that top line total portfolio, you have about 10% of your assets in emerging markets. That is across equities and fixed income. Okay? The equity exposure is that 6.48, which is the second line there, and that's primarily in your two EM strategies, your dedicated emerging market strategies. SSGA currently and Wasatch, that makes up about 4.5%. Lazard and Harding Loevner, as you know, your international developed strategies, they have some opportunistic exposure to EM. It's a small piece of their portfolios, but it's adding to that. And then the K2, long-short equity, global long-short equity, that includes some emerging exposure, and so that's on a look-through basis. The other areas you're getting it, Brandywine on the bond side, it's intentional. That's been a very big positive as those emerging market currencies have really appreciated relative to the dollar over the last several months. That's been a big positive. And then you have some in the WAMCO and PAMCO strategies on the bond side, and that has been a big positive more recently. It's not outside the targets or ranges that we've set within your policy. But I want to point that out. Page 26, again, looks at some of the risk characteristics that we highlighted earlier. This is just going back to 2002, so this is when we started measuring, so over a 14-year period. I think it's just important, as I mentioned, that the one thing that you can control is risk. We want to make sure that we are getting that risk right. The risk in this portfolio, if you look at the upper right, standard deviation over that 14-year period below the target index, the Sharpe ratio, which is a measure looking at risk and return together. So are you getting compensated for the risk you're taking more efficiently than what the asset allocation would suggest? So a higher Sharpe ratio, the better. It's an indication that you are getting an efficient use of the risk that you're taking. Lower left, I think, is sometimes a good chart to look at because oftentimes we get hung up in what's the percentage gain and don't really think about it in terms of dollars. But what this is showing is the growth of a dollar in this portfolio beginning in September of 2001. So you can see that for every dollar that you had in the pension fund in 2001, every one of those dollars is now worth $2.40. So basically a 2.4 times multiple of on cash over that period. And really, you could say that that's since March of 2009. You've made a 2.4. The portfolio has gone up by 240%. Page 27 looks at some peer group data. The 1 year total return for the portfolio, gross of fees, is 8.95, net is 8.31. A little bit behind the policy index over that 1 year period. That's getting less risk in the portfolio. The active management, particularly the long-short equity, has been the biggest detractor from returns in a period where primarily long-only large-cap U.S. stocks and being indexed was the best place to be. You trailed a bit, ranking in the 71st percentile. 3 and 5 years, you can see returns, gross of fee returns, and we measure gross because the peer groups are gross of fees. These are total fund peer groups. We're measuring you. The gold bar is other institutional funds. IF stands for Investor Force, not institutional funds. Investor Force is the peer group provider. But it's other institutional, not just public pension funds, but corporate pension plans, endowments, foundations, with a target allocation of 55 to 70% equity. So similar equity-like allocation. Over that 5-year period, your portfolio ranks in the top third of all of those types of funds versus other public defined benefit plans. That's the second number behind where it says ranking there in the middle of the page. in the 31st percentile. So that, again, the top third of public defined benefit plans over that 5-year period. So performing well on a absolute basis relative to your primary target, relative to the policy index, and relative to peers. Question? Oh, I'm sorry.
27.
Page 27.
Jason, when do you anticipate, I noticed we're still in the State Street for the emerging markets. When do you anticipate the move to the new fund manager?
November 30th. Correct. The contract's just being wrapped up, and so that the transition will move all of the assets from the State Street EM index to the Wells Berkeley Street Fund. Just briefly, if you want to look at the ASAP, we won't spend too much time on this. The month was a pretty tough month. The one thing I will say, if you're looking at, you can turn to the second page of the monthly flash report. You can see the total fund was down 1.38% net of fees for the month, 1.34 gross. So markets were down 1.5%. The one thing that we are starting to see over the course of the last really several months now is that active management or fundamentals beginning to take over again. I think I talked about this last month, but earlier in the year it was a very risk-on trade, and all assets were going up. It was really difficult to outperform the indexes, but it wasn't really fundamentally based. The things that had done the best were utilities, real estate investment trusts, things that offered a yield as investors were really searching for yield. Those things have really unwound over the last couple of months. Some other characteristics or things that we've looked at was in terms of a manager, and not in your portfolio, but showed us an analysis going back 25 years and looking at that on a quarter-by-quarter basis, the top 10% performing stocks in the S&P 500, what their earnings growth characteristics typically are. On average, the earnings growth of the top 10 percentile stocks on a quarter-by-quarter basis is in the 12 to 13 times, or 12 to 13% earnings growth range. Over the last several quarters leading up to the third quarter, the top 10% performing in terms of stock price had negative earnings growth. That doesn't fundamentally make sense. So these are the utilities companies that they're not necessarily growing earnings. The real estate investment trust, not growing earnings, but they're offering a yield, and lots of money was flowing into that, pushing up prices. Fundamentally, we don't believe that that's sustainable, but that's been a big headwind for active managers, and that's a little bit of anecdotal example. But now if we look at, and I use your long-short equity as the primary example of active management because it is the most active management that you have. The quarter ending September, the K2 strategy was up 5.67%. The S&P was up 3.85%. This is in the quarter report on page 30. So a very good quarter for active management, if you will. The one-year return, so now this is taking into those periods where I'm saying fundamentals really weren't driving. The one-year return is up 1 versus the S&P 500 up 15%. So a big lag early in the year, and that's been the headwind in overall in the portfolio. But as we're starting to see things turn around a bit and fundamentals mattering, at least in the short term, that active management is starting to pay off. And for the month, the long-short equity did provide some protection at down less than the long-only markets, about half as much. So starting to see some benefit there. No, with the exception of the change in the EM strategy, getting that funded, no manager issues or concerns at this time.
Okay, other questions for Jason?
Okay.
I do have one. I heard someone say recently they were going back to 2015. They were talking about the S&P 500, et cetera, and They use the acronym FANG of why it did so well. F for Facebook, A for Amazon, N for Netflix, and G for Google. Are those still doing well?
Well, in 2015, really those four stocks drove the market.
Right.
They haven't, you're starting to see a little bit more broad-based, particularly in the quarter. And through 2016, the leadership has become a little bit more broad-based. It's not just those four stocks. But I think more importantly is just looking at how well U.S. large cap stocks have done. Just looking at the S&P since 2009, it's been pretty much a ride straight up with a couple of small little blips, and that's put a lot of pressure on active management and a lot of discussion around active management. But just like anything, we think that performance is cyclical, and when things run up, their bubbles are created, and we're seeing now while you have a very benchmark risk-controlled approach within large cap, because you have passive with the SSGA, S&P 500 index, and then you have Intech, which is generally taking very small bets relative to the index. So you're not taking major active bets within large cap, but you are taking it elsewhere. That hasn't been the elsewhere, those bets elsewhere has not been beneficial, but we think it will be going forward, and that the things to be concerned about is what's gone up the most recently, which is S&P 500. It may have been led by the FANG stocks for a period, but those things are the most expensive. And so being able to differentiate and buy some other things we think is important going forward.
Okay. Just a quick if scenario. If corporate taxes do come down, a lot of money comes back in, how will that affect the bond market?
Bonds, not great. Bonds are more concerned about rates going up. So repatriating some tax revenue, I don't know, is that what you're referring to? Foreign cash in corporations? I think I heard that there's like $2 trillion worth of cash. Even if they lower tax rates on corporations and that comes back in at 10%, it could be like $200 billion in tax revenue. So that's a big positive. But overall, revenues for the government will come down. Okay. But as far as the bond market, I think that it's the challenge is going to be rising rates. But longer term, for a pension fund, rising rates may be painful in terms of asset valuations near term, but longer term, having higher rates is better for your liabilities and other factors.
Good. Thank you, Jason. Anyone else? Okay, we now have a quorum present, so we can go into our order of business here. And number 3, ratify approvals.
Approve the minutes.
Okay, excuse me. Number 2, approve the minutes from the last meeting. Got a move in a second. All four signify by saying aye. Aye. Any opposed, same sign. Hearing none, we will go to number 3, ratify approvals. We have got to move on in a second. Any questions or comments? Before it, signify by saying aye. Aye. Any opposed, same sign. Hearing none. Number 4, approve the claims docket. Got to move in a second. Any comments? Before it, signify by saying aye. Any opposed, same sign. Hearing none, approved. We go to number 5. We have 2 items under number 5. Move in a second. Any questions? Before it, signify by saying aye. Any opposed, same sign. Hearing none, we will go to number 6, where we have 4 items. Any comments? Before it, signify by saying aye. Any opposed, same sign. Hearing none, 6 approved. We'll go to number 7. We have 1 item. Any comments? Hearing none, before it, signify by saying aye. Disapprove, same sign. Hearing none, sorry, go to that. And number 8, we have 2 items. Any comments? For it signify by saying aye. Any opposed, same sign. Hearing none, that's approved. And we go to number 9, 1 item. Okay, any comments? You're for it signify by saying aye. Opposed, same sign. None, hearing none. Number 9 is approved. We've already had number 10, which is the investment consultant report. Any comments from the board, staff, or citizens? Do we need to move for adjournment?
You can just order it, where there being no further...
No further comments or questions? We are adjourned. Thanks, everyone, for being here.